All right, let's just dive straight into what I think is an absolutely fascinating valuation mystery today. For this explainer, we're going to roll up our sleeves and step into the shoes of professional sell-side equity analysts. Our goal? To figure out the true intrinsic value of eBay. We're applying rigorous, fundamental valuation models to the raw financial data to see if the market is actually pricing this e-commerce giant correctly, or if there's a massive mispricing just hiding in plain sight.
Right out of the gate, we are hit with a glaring paradox. On one hand, you've got these incredibly impressive market gains, a year-to-date return of over 24% and a massive three-year return of over 146%. But then you look at the fundamentals and they are, frankly, terrifying. We're talking about a margin of safety sitting at a negative 79.91%. As analysts, a disconnect this huge is exactly what we hunt for. It tells us one of two things. Either the market is completely ignoring the fundamentals or our models are missing a massive growth story.
And that brings us to eBay's current trading price of $107.69. This is the ultimate target we're forensically investigating today. We have to figure out, is this nearly $108 price tag actually justified by the cash the business generates, or is it just inflated by market exuberance? We're going to build out our model step by step to answer exactly that. So here is our roadmap for today. We'll start with the paradox between price and value, then move into absolute valuation using a DCF model. After that, we'll look at dividend and residual income models, shift to relative valuation, discuss our model limitations, and finally deliver our final equity verdict.
Okay, section 1, the paradox, price versus value. Let's really unpack this disconnect. When we look at the raw financial data, the fair value price based strictly on free cash flow comes out to a mere $59.86. I mean, wow, that is drastically lower than that $107 trading price we just looked at. If you're a value investor who anchors decisions purely on the actual cash a business throws off, buying in at almost $108 looks like a profoundly risky bet right now. Moving on to section 2. Absolute valuation, specifically looking at the discounted cash flow model. To build out our DCF, we have a clear set of steps. We start by extracting the trailing 12-month free cash flow directly from the documents, which sits right at $1.434 billion. From there, we need to estimate our cost of equity and YSEC, calculate the terminal value, and finally, discount all those future cash flows back to today's present value. This gives us our core baseline.
But, as any seasoned analyst will tell you, a model is only as good as its inputs. So we have to raise what I call an assumption flag here, because the exact weighted average cost of capital and terminal growth rates aren't explicitly handed to us in the source data. We have to plug in sensible industry defaults to actually complete the model. For a mature tech marketplace like eBay, assuming a 5 to 6% market risk premium and a modest 2 to 3% terminal growth rate makes fundamental sense. This lets us test the sensitivity of that $59 fair value.
And here's where things get really interesting, because this perfectly illustrates why that DCF valuation is dragged all the way down to $59. Look at the discrepancy. While net income is surging with a 3-year compound annual growth rate of over 53% and revenue is growing steadily at about 4.25%, the 3-year free cash flow growth is actually bleeding. It's at negative 7.38%. The trailing 12-month free cash flow growth is even worse at negative 26.69%. You literally cannot justify a sky-high DCF valuation when the actual cash generation of the business is shrinking year over year, no matter how good the accounting net income looks on paper.
Let's turn to section 3, dividend and residual income models. We need to look at alternative ways to value this equity. If we build out a multi-stage dividend discount model, we need to track historical dividend growth. eBay actually has a solid 5-year dividend growth rate of 11.47% and a 3-year rate of 7.44%. Plus, they maintain a very sustainable payout ratio, currently sitting at a really healthy 26.97%. Now, with 7 consecutive years of increases, this model definitely shows a company committed to returning capital. But with a current yield of only 1.15%, that dividend alone is just not going to justify a $107 stock price for income investors. But wait, if we pivot over to a residual income model instead, the picture changes entirely. eBay starts looking phenomenally stronger. They boast a massive 44% return on equity and a 20.5% return on invested capital. These are just incredibly efficient metrics. This level of efficiency easily justifies why the stock commands such a high premium. Specifically, a price-to-book ratio of 10.48 over its actual book value.
Basically, they're exceptionally good at generating profit from the capital they actually deploy.
All right, section 4. Let's look at relative valuation. How does eBay compare to the rest of the market?
For this, we check out market multiples. eBay's price-to-earnings ratio is 24.81, its enterprise value to EBITDA sits at 16.41, and its price-to-sales is 4.32. Now, because the provided documents don't list specific competitors, we have to make a clear external assumption here. We need to pull in conceptual peers, think companies like Etsy or Amazon, to figure out if a 24.81 PE ratio is a bargain or if it's overvalued for the specific sector. Interestingly enough, eBay's current PE is almost 35% higher than its own 3-year average. So even relative to its own recent history, the stock is trading at a pretty significant premium right now.
That brings us to section 5, model limitations. We have to be completely transparent about the data we don't have.
So we initially really wanted to run a sum of the parts, or SOT, valuation. The idea was to independently assess distinct segments, like completely separating the core marketplace from their advertising revenues or their payments division, just to see if the individual parts are actually worth more than the whole. However, because our source documents just lack that granular segment reporting and distinct debt schedules, we're forced to skip the SOTP and adjusted present value models entirely. Look, as an analyst, you never want to force a model when the foundational data just isn't there. Making up segment margins out of thin air is a surefire way and end up with incredibly unreliable valuations, and we're definitely not going to do that here.
We can, however, run some asset-based valuation checks. eBay's current ratio is a tight 1.10. Its debt to equity is 1.46, and its enterprise value to assets ratio is 2.90. So what does this actually tell us? It tells us that eBay's value is heavily tied to its intangible brand and its massive network effects, rather than just hard physical assets that could be easily liquidated. If you tried to value eBay strictly by selling off its servers and office buildings, you would come up radically short of its actual market cap.
Finally, section 6, the final equity verdict. Let's bring it all together.
Depending on what metrics you prioritize, you get two vastly different intrinsic values here. If you anchor your models to that struggling negative growth free cash flow, your bear case fair value comes in at just $59.86. But if you build out a bull case anchored to their surging earnings per share and that sky-high return on equity, your calculated intrinsic value tops out at $91.61.
So with the stock currently sitting at nearly $108, which is well above even our most optimistic bull case scenario, you really have to ask yourself, is the market seeing some magical future growth narrative in e-commerce that we aren't? Or is this a classic overvaluation trap, just a stock driven up by sheer momentum, waiting to snap violently back to its fundamental realities? It is a truly fascinating standoff between price and value. Keep these models in your back pocket the next time you're looking at a surging stock ticker. Thanks so much for joining me on this fundamental breakdown.